What's up, ladies and gentlemen? Welcome to today's edition of Free Tool Friday. I am your humble but oftentimes overly energetic host, and we are going to be discussing one of the most talked about topics in the accounting industry today, and that is how to price your services profitably and efficiently. Make sure your clients get exactly what they need, but also can recognize the value that you are bringing into those relationships and engagements. But before I do that, I'm gonna rant a little bit. I don't like to rant, but as Kanye says, it's really more of a symphony of ideas. Good way of thinking about ranting in the future. I'm not a big Kanye fan, but anyway, point is, there is a reason that your services are not valued the way they should be. And it's a pretty obvious reason, but not a lot of people can see it. And a lot of the other thought leaders out there, I love them. I love all the other thought leaders out there, the pricing experts, all the other marketing coaches. I love all of you guys. I do. But we have to analyze the language that we're using, and the language we're using is the F word. We're using the F word so much in the accounting space, and it has to stop. Ask all my clients in the Create Your Dream Firm program. The F word is never allowed. As soon as the F word comes up, it's the swear jar. You got to dedicate money into the swear jar when you start swearing, because using the F word takes away from your value, and value is a synonym for results or return. And in order to get a return, you can't use the F word. And the F word is, who's going to get it? Who's going to get it down in the comments? Anyone get what the F word is yet? The F word is fees. It is fees. Fees, 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 fees. Fees are unacceptable. I want you to think about the last time you got charged for a fee and were happy to pay it. I want you to think about the last time you made an investment and the associated value you got on return for making that investment. I want you to think about the difference between when you have to pay a fee versus when you choose to make an investment. The language you use matters. It is the difference between the perception of something. Literally, our perception is our reality. The perception of the way we see something versus the true reality of it. And the true reality is you are incredibly valuable. What you have to offer is incredibly valuable. But if you use the wrong words associated with it, especially when it comes to pricing, guess what's going to happen? They're not going to see it or understand it as valuable, right? You can't use the word fee. Literally, I want you to think about it as badly as you think about the true F word. Don't use it. Don't use it. Think about how you can say any other word than that. Because look, I was doing a little bit of research before this, and I was trying to say, like, what are all the different ways in which the term fee is used? Fees for parking tickets, convenience fees to use credit cards. I remember when I used Ticketmaster and I was getting ready to go to an Eagles game, go Birds, even though they were terrible this year. And I'm so excited. It's like $100 ticket. I'm like, oh my God, I'm going to finally go see the Eagles. And I'm like, wait, why is it $115? What is a convenience fee? It's like, what is this? You're charging me money to use a credit card? What? Like, I was so angry. I was just overdraft fees, right? It's like, oh my God, the transfer fee that I paid to move money from one thing to another, it didn't clear in time. And I got hit with this overdraft fee. Now I'm wasting all this time on the bank that charged me the fee in the first place. It's like, I'm getting ready to drop real F-bombs thinking about this because, oh my God, it's unbelievable. And you got ATM fees. It's like, I just want to get my money. $5, get your money. And it's like, oh my God, I get that there's a service associated with this, but man, that is a brutal thing to pay. It's like every time I go to Wawa, shout out Northeast, I got to use these ATMs and they're taking money out of my bank account immediately. Minimum monthly maintenance fees, right? It's like, well, just to have this, you have to have there's maintenance. And it's like, it's just literally sitting there. What do you mean there's maintenance associated with it? Or a minimum monthly investment fee? It's like, you mean because I don't have as much money as someone else, I have to pay a fee so that I have less money? It's like, what? Debit card replacement fees, early account closure fees, money transfer fees, ticket change fees. Oh, I'm sorry. You need to change your flight ticket, sir? Oh, I'm so sorry. It's a $500 fee because you had a death in the family because you're so sick you can't stand up right now. I'm so sorry. Here's the fee. Right. Baggage fees. Oh, you want to get on the plane? You're ready to get on the plane? Oh, you want to bring stuff with you? Oh, you forgot about the baggage fee? It's like, oh my God, F word, chaos. It is absolutely insane. So this is my humble request to everyone listening to this, to all the other accounting professional coaches, thought leaders, mentors, any of you out there, stop using this word. It is hurting the perceived value of the industry at large, okay? And it's a traditional, old school, old world way of talking about pricing. There's no reason to continue to do it. If you just substitute the F word, okay, I'm done using it now. If you substitute the F word for investment, all of a sudden the perceived value is significantly higher because investment automatically implies return or result, and value is a synonym for result. You want your value to be seen, more recognized? That's one of the ways that you can do it quickly, efficiently, and immediately. It requires nothing other than being cognizant that that is old, outdated, useless language, and we can use better, updated, modern language that properly reflects what you're all about. Okay, so with that said, we're actually here to talk about pricing, not just pricing psychology and being able to make sure that our value is better understood. So what we're going to do is we're going to simplify this. And in order to simplify it, I'm going to use one of my favorite coaching lessons. And in all fairness, I learned this lesson originally from Russell Brunson. Of course, I've reapplied it to the accounting industry. It's known as the value ladder. Okay, it's how do you create a simple approach to having people access your services, and at what layer can they access the variety of services? And so the way that Russell teaches this, and it's the same way I like to teach it, is always start with the end in mind, right? Like when you are imagining delivering max value for your clients, maybe CFO, maybe tax planning, maybe some really extensive bookkeeping, whatever it is. When you imagine that service, I want you to say what's included, like literally down, like the minutia, what is included, detail out. If you say CFO, I'm sorry, most people have no idea what that means. What are the actual services? How often are they delivered? What's the access they have to you? Please provide the detail for this. So you've got all of that, and say, what would I charge to be able to access this? Now, I know there's a variable rate associated with this, and this is why most people have struggles with pricing, because they go, well, not every client's the same. Different businesses, different sizes, different requirements, different personalities. And what we want to do is we want to simplify what's complex, right? To make it more powerful. So you've got your top end. You're going to jump down. You're going to have a middle end. You're going to jump down. You're going to have a bottom, okay? Or you're going to have your introductory, your middle, and your top. So in order to help make this lesson stick, I have a literal value ladder pre-built. Now, of course, you will build this based on how you'd like, but it's pretty easy to remember, and it's got associated pricing thresholds with it. Let me explain. BC, AD, pretty easy to remember, okay? BC stands for basic compliance. MC stands for max compliance. AD stands for advisory services. It's extremely straightforward. Next to this is the associated pricing thresholds. I'm going to explain these in a minute. Very simple, but you can see that it goes from 1 to 2 to 5 plus. Okay. Now, again, if we start at the top here and we have our advisory service, max value that you and your firm can deliver, because remember, it's not just you, it's your team. Got 5%. So let's say $1 million company in your target niche of choice. Okay. And let's just say it's a construction company. Okay. So you got a construction company coming to you doing $1 million a year. And you've got your advisory package, you know that's a good fit for them. So it's 5% of revenues. Okay. 5% annually, million divided by 12. Sorry, 5% of $1 million is 50. 50 divided by 12 is somewhere in the ballpark of, man, my math, somewhere right around about $5,000 a month, somewhere in that ballpark, a little less, maybe 4,500. So 4,200, someone help me in the comments. Point is that is how you get to a good quote. Now, again, remember, this is a quote. I have to emphasize this, so we'll come back to that in a second. This is a quote, okay? If you dive into their QuickBooks, or if you had the conversation with a partner and then you meet the other partner and he's a disaster, right? It's just like, nope, like, no. This is a quote. This is to determine whether or not it's even worth continuing the conversation to create the proposal. It gives you an area in which to understand if they have recognized the value and you've done a good job of expressing the services and the associated return on the investment of $4,500 a month, right? Now, it's a $4,500 per month fee. F word, no, right? Big difference, huge difference. So, okay. Now let's say maybe they don't really need advisory, don't think they need advisory is probably a better way of saying it. And so we go, well, maybe they're more of max compliance. And max compliance is essentially everything compliance related. I like to say advisory is that forward thinking, proactive approach. We want to get there. Not everyone's going to be there. That's okay. Meet them where they are, give them what they need, and understand that people go from basic to max to advisory, right? Like it flows up as their business grows. A lot of people say, I only want to do this. I only want to do this. And I go, I love that. I think that's the only thing you should do too. But the vast majority of the market is not ready to meet you here yet. This requires a lot of trust, requires a lot to be in place to get them there. It's not to say it can't happen, but I'll say maybe 10% of all your opportunities will naturally just be able to be here. So are you just going to take all the other 90% that you could be profitable on, potentially not do any work with, and just throw them out the window? No, that doesn't make any sense. So you say, okay, well, if they are more of a better fit here, well, am I, as the owner of the firm where I deliver max value here, am I going to spend a lot of time down here? Probably not, right? Like that's the goal. Like this is how you have a business that generates income without your direct time. Systems, Create Your Dream Firm program, come join, link down below. Max compliance. This is, again, everything that needs to be done, but doesn't require forward thinking. And basic compliance is essentially that. It is for the people that are going to need to have a quarterly touch point, maybe a year-end tax return. You'll determine what that is based on your business model and what you want to do. But it's like, how do you just keep a finger to the pulse of their business and their life cycle so that when it becomes apparent, right? You don't want the business that's $80,000 today could easily be $250,000, $500,000. Business that's $250,000 could be $1 million a year from now. And you turn them away because they weren't ready for this. But a year later they are, right? Or a year later they move up to here. And since this is based on percentage of revenue, what happens when their business grows? You're directly tied to that. So if a business that's on basic compliance is only maybe doing 6 figures and might only be worth, $1,000, $1,500 a year, again, 1 to 1.5%, you're not doing a ton for that. It's still a profitable engagement, but now that business goes to 300,000, right? And now let's say it's 3.5% of revenue or 3%. Okay. Well, not only did their business triple, so their investment would have tripled here, the delivery of what you're giving them is going to triple. So by extension, you literally, what is that, like a 9X, right? At that point, like 3 times 3, it's insane. But the point, this is the point is get them here, bring them here, get them here, bring them here, get them here, keep them there. So there is a ton of simplicity in this. And it starts with defining each of these tiers in detail and being able to quote, you're not married to it, quote accurately and profitably and keep them in that package. And when they're in that package and they naturally grow, that you can then ascend them to the new tier, making them more profitable, delivering better results, all the wonderful things that go along with your services. This is the simplest way to approach this. And there's a little hidden line down here. And what's interesting about this line is that this was, so this is known as the hidden step in the value ladder. And this again comes from Russell. And Russell's hidden step is actually recurring revenue. That's what he refers to. I think he might have changed his stance on that recently, but it doesn't matter. The bottom line is recurring revenue. Now, the nice thing about most of your models is recurring revenue is naturally baked into it. You need accounting on a regular basis to run a successful business. And so when you need accounting on a regular basis, this line actually shifts a little bit. This to me is the line of how do you get paid without needing to deliver directly on the service? How do you get the returns that other people are making, right? Like when someone else is doing a service, how do you get paid on facilitating that relationship? How do you do that? Softwares, financial planners, estate planners, right? Like insurance, legal, all of these different things that businesses need. And you have trust of high net worth clients or great clients, and they need those services. You facilitate that, get a slice, That's a pretty good deal, right? That's how you increase your profitability without requiring you to spend more time on service development inside of your own business. Okay, I have one other thing that I want to talk about with this, because I feel like that this is why a lot of people struggle in the sales environment once we get to the conversation, okay? And the question is this: do you believe that once you have these things listed out, do you believe that A, it should be listed on your website? Do you believe that you should put your menu of services available publicly? And B, do you believe that you should have pricing associated with that menu of services? Okay, so let me know down below if you believe that, okay? And before I answer that question, I'll give you people some time to answer. Again, do you believe that you should have these as listed on your website publicly? And do you believe you should list pricing? Just what do you think about that? What I will say is that when you do this exercise, your pricing, yes, the variable is meant to be accounted for inside of the percentages, right? That's meant to be the variable because complexity increases as the business grows. That's just a fact. What you should do is set what I'll refer to as the floor on your pricing. So for advisory, if you have a $250,000 a year company, you're probably not necessarily going to do advisory for them. You might, again, that's your choice. But if you set the floor on it of being, $2,500 a month, that's 10% of that company's revenue. I don't think they're going to agree to that. And I don't think you should probably have them agree to that. You might, right? Again, like depending on the situation, their growth trajectory, maybe. But as a general rule of thumb, typically outside of 5%, it gets hard to quote and have people agree. Again, it depends on the industry. This is just a benchmark for people to use. So if you have established floors, you know that you will not go below that pricing. Okay? That's just another way of doing it. So back to the question. Should you display your menu online? Now, allegedly, pricing psychology suggests that you should. Maybe it's correct. I don't know. Maybe people pick in the middle, but I'm going to share with you an example of something similar that I look at a lot. I think a lot of you look at a lot, and I don't know if you treat it the same way I do, but I'm going to share with you when it is presented publicly online, typically what I think happens. So I'm going to share my screen. And so this is biggest sales CRM company in the world, right? Salesforce is man on top of the hill, or the king of the hill, or whatever. Now, I don't know about you. I naturally, and I want you to do it yourself, but tell me kind of where your eyes gravitate. I know there's 4 instead of 3, but my eyes naturally gravitate towards the left. First of all, because we read left to right. That's just the way our society is built. And it's also the lowest. And I look at it and I say, can I get what I need for the lowest dollar amount possible? Now, that doesn't make me a price shopper. It makes me a value shopper. I'm trying to make sure that the result that I want is at the price that I need it to be, right? It's the same, right? I'm making an investment. I want the return. Do I need to invest more to get the return that I need? If no, why would I invest more? So then I start looking at this and I go, again, that's what I'm doing. I'm looking left to right. And then I start analyzing it, and I start going, well, X, Y, Z, I'm not sure, right? Maybe, do I need, well, what does lead registration and rule-based lead scoring even mean, right? Do I need that? Imagine if this said, instead of this, which I kind of know I do know what it means, but imagine if it's instead said something like CFO cash flow forecasting. And again, most business owners, they're going to look at that and they're going to go, I'm not really sure I need that. I don't know, right? Most entrepreneurs come into this and they go, I don't really know. Do I need that? I'm not sure. And so the point here is that what we did is we introduced complexity into the equation. Because now the prospect is coming to your conversation having seen something, and now maybe some negotiation starts where they want this, but they want to pay this price, or they want that price, but they want these services shuffled over here. And all it does is it's complexity. It makes it harder to do it, whether price is included or not. I don't like to introduce complexity into sales conversations. And the reason this is so important is when they are coming to speak to you, when they are coming to listen to you, when they are coming for your guidance, your expertise, why are we giving them power on the front end to make decisions about things they don't fundamentally understand? I don't think that that is the right way to approach it. I know that goes against a lot of schools of thought that say that you should put those things out there. I treat this as an internal document for your firm. This is something that you use to keep conversations on the rails and understand exactly what they're going to get, but you place them where they need to be based on your understanding of their situation and where they are with their business and realistically what they need. Because if they come into the conversation, right, and shout out to Shay for this, oh, it's pretty simple, right? Oh, it's really simple, right? And it's like, so I need the smaller one. It's like, wait a minute, based on what we've just talked about, no, you don't. They don't even know what the smaller one is unless you show them what the smaller one is on the front end. It creates complexity, and I don't think you need to do it. So just to recap, I don't think you put this publicly online. My personal preference, people are happy to disagree with me. I just think it's a mistake. Don't ever use the F word, substitute it for investment. Don't ever use it. It's not necessary. You literally diminish your perceived value every time you use that word. Stop using it today. And this is ballpark quoting prices: 5% of annual revenue, 2 to 3.5% of annual revenue, 1 to 1.5% annual revenue. As long as you give them a quote, right? It's a quote. You're not married to it. It lets you know whether or not you should proceed with a proposal. And if you're in the same ballpark of existence in terms of what the true investment of your service requires, and it allows you to be very profitable and stay within an established spend threshold. So I hope you found that to be informative. I hope I simplified it, gave you some good language tips to use to increase perceived value. And as always, it's a pleasure to have all of our proactive accountants with us. If you want to take things up to the next level and not use tax season as an excuse to prevent building your dream firm, there will be a link down below. Schedule your call, apply to work with us, and we'll have you moving faster toward your dream firm than you would believe possible. My name is Tyler S. Clark. Thank you so much again for investing your most precious resource with me. Remember, only you can create your dream firm, but we help you every single step of the way. I'll see you all next week, and don't let your pricing be complex, and never use the F word.